Hi friends, welcome to the channel JIV and CIV Made Simple. Today we are going to discuss Iibf Certified Credit Professional Memory Based Question and Answer Session which were asked on the paper which held on 13th December 2025. So these questions will help you see what is the current pattern, what kind of question are being asked, what are the important topics, and also some question will get repeated exactly as it is, as it has been observed in the last few lectures. So I request you to please watch the entire video, and if you have not seen the earlier memory based question paper, check out the description section of the video. I have added many of them. So let's get started. The first question is on your screen. The credit turnover ratio of a firm increases significantly in a financial year. So which of the following is the most appropriate interpretation of it? Yes, so as you can see, credit turnover ratio has increased significantly. So how can you interpret it? Right. So option they have mentioned that the firm is delaying payment to supplier indicating weaker liquidity. The firm is paying supplier faster showing efficient short-term liability management. The firm credit purchase have decreased automatically proving improved liquidity. The firm creditor balance has increased meaning the firm is taking longer credit period. Now very good question it is. Please pause the video, think about it. So CTR has increased significantly. So what is the interpretation? That is what is asking you. So let me explain. So imagine that you buy a good. Suppose this is you, right? And you are buying goods from where you are buying goods from supplier. You are buying goods from supplier, right? And you don't pay immediately, right? You don't pay immediately. So the credit turnover ratio CTR, it tells us that how fast the business pay back its supplier, right? So how fast the business pay back the supplier, right? So what is the formula for CTR? The formula is very simple. In the numerator you write what? In the numerator you write net credit purchase. In the numerator you write net credit purchase, and in the denominator you write net credit purchases, and denominator you write average creditor. Net credit purchase upon average creditor, that is what will give you CTR, or CTR we call it, or credit turnover ratio we call it CTR, right? Now think logically. If the company start paying supplier quickly, think about it. Suppose this is a company, right? It start paying the supplier quickly, right? So the creditor balance goes down. If the company start paying back the supplier quickly, so what will happen? Automatically, creditor balance will go down. And when the denominator, what is the denominator here? Average creditor, right? And when the denominator, which is average creditor, become smaller, the turnover ratio will become bigger. So when the ratio increases significantly, what does it mean? It means that company is clearing supply due more frequently. As you can see, so when the average creditor decreases, CTR increases. So when the CTR increases, it means company is clearing the dues, right? Company is clearing the dues more frequently, and it also means that payment are happening faster, right? Payment are happening faster, and it also means that liquidity position is getting comfortable. Liquidity position is getting comfortable. So three things we can interpret. If the CTR is increasing, company is clearing dues, payment is going faster, and liquidity is looks comfortable. Now let's look at the option. Option number A say the firm is delaying payment. This is wrong. If the company delay payment, what will happen? If the company will delay payment, creditor balance will increase, and creditor balance will increase. It means denominator increase. It means the ratio will decrease, not rise. Here we are talking about increase, significantly increase, right? Increases. So this is not the correct answer. What about B? Yes, B is the correct one. What about C? Credit purchase have decreased, proving improved liquidity. That is what it is reading. Credit purchase have decreased, proving improved liquidity. Actually, just because purchase reduced, it does not prove that liquidity improved. Right? Ratio depends on two things. If you look at this particular ratio, there are two parameters: net credit purchase and average creditor. Without knowing creditor balance movement, you cannot conclude liquidity improved. Right? And what about option number D? So C is also wrong, right? What is the interpretation? C is wrong, A is wrong. What about D? D says that the firm creditor balance has increased, meaning the firm is taking longer credit period. C. So creditor balance has increased. What will happen if the creditor increases? If the creditor increases, our denominator will go up. As you can see in the formula, our denominator will go up, and if the denominator will go up, this ratio or CTR will go down. So this cannot be the interpretation of increasing the ratio. So you can think of it like, I'm giving you a simple way to remember. You can think of it like, a speedometer, right? So if you have higher CTR, if CTR increase, it means payment speed is higher. Payment speed is increasing. Just remember it. More turnover means more money is turning faster into supplier. Right. Faster to the supplier means more money is turning faster to supplier. So turnover is increasing. Think about it. Turnover increasing. It means, payment speed is increasing. Right. So what we learn from this discussion is that, what we learned? We learned that basically creditor turnover ratio is the ratio of net credit purchase upon average creditor. First point, net credit purchase upon average creditor, that's called CTR. And this CTR, if its CTR increases, it means company is paying supplier faster. Company is paying supplier faster. And if the ratio is high, so this high ratio means, good short-term liquidity. Right? Short-term liquidity is very high. So the correct answer is option number B. I hope this is crystal clear now. Friends, this way I have explained in our previous session, and if you want complete description of the entire question which have appeared, you can enroll in our CCP course. The link is provided in the description section, or you can WhatsApp me on this particular number. In this course, you get unit-wise theory PDF, unit-wise concise notes, module-wise quick revision PDF, along with previous year question paper. There are 10 to 12 previous year question paper, and each one containing 30 to 40 questions. Overall, it is almost 400 questions. This will help you gauge the depth of the question, and most probably many of the questions will get repeated from that particular PDF itself, as it has been reported by the aspirant who have given the examination. Now let's see one fill in the blank MCQs. Fill in the blank type MCQs, which is based on RBI norms on loan against share. So the question is, as per the RBI norms on advance against the share, bank cannot grant loan against their own share as per section dash of the BRA. Bank may give loan to individual up to dash lakh for physical share and up to dash lakh for demat share. Bank must maintain a minimum margin of dash percentage for loan against the physical share. So three concepts are there. Let me explain one by one. Option they have given. So let me zoom out a little bit. So this is the entire question. Please pause a little bit and think about the answer. Let me explain. So first of all, let's talk about the section 20 subsection number 1. Let's talk about this section. So let me explain this section 20 subsection 1. What does it say? That bank cannot take their own share as security. Imagine there is a bank, right? Imagine there is a bank, and that bank is giving a loan. That bank is giving a loan by keeping it on share as collateral. The bank is keeping on share as collateral, right? So that is risky, right? It's quite risky. It's quite unfair. Very risky and very unfair. So section 20 subsection 1, of the BRA clearly prohibited that bank cannot, bank giving a loan by keeping it on share as collateral, it cannot be done. So bank cannot grant loan against their own share. Very, very important. That is section 20 subsection number 1. Now the second point we have is the loan limit for individual. Loan limit for individual. So RBI has fixed limit to avoid access risk. So what is the limit? 10 lakh loan against the physical share. 10 lakh loan against the physical share, the old paper share certificate, and 20 lakh against the demat share. Please remember this limit, right? So demat share are more secure and transparent, so higher limit. The third point is about the margin requirement for physical share. So how much margin means what? Whenever I say this word margin, it means how much the borrower must bring from their own pocket, right? So margin means, borrower's pocket. How much the borrower must bring from their own pocket. See, if the margin is, suppose margin is 50%. So what does it mean? It means the bank will give only half the value of share. Bank will give the half the value of share, right? So let me give you one example. Suppose value of share is 1 lakh rupees, right? And bank loan allowed is, suppose it will be 50,000. Right, so that is 50% margin, right? So I hope this is clear, crystal clear. So what we learned from the discussion is that, correct answer to this question is, right. So first one will be section number 20, subsection 1. Bank cannot grant loan. Loan of individual to 10 lakh and physical share up to 20 lakh for demat share. And minimum margin of 50% for loan against physical share. So I hope the correct answer is option number A, right? So basically you can remember it like this. Let me give you a trick to remember all this data. So this is called 10 20 50 rule, right? For share loan. It's all about share loan. Remember 10 lakh is for what? Physical share. 10 lakh is for physical. This is a limit for the physical share given to an individual. 20 lakh is the limit for demat share. And this 50%, this is the margin. This is the margin on physical share. This is called margin on physical share, right? And when one may remember, there's a section name 20 subsection number 1, right? What does it say? That no loan on share. No loan on share, right? I hope this is crystal clear now. Now friends, let's switch our focus to the next question that we have. Next question is, which of the following correctly describe the fee structure applicable to the cases filed in the Lok Adalat in India? Right. Option they have given: a nominal court fee is charged but it is adjusted against settlement amount. B says no court fee is charged for filing case, and if a court related case settled, the original court fee is refunded. C says a fixed Lok Adalat processing fee, right, is charged by banking cases up to 20 lakh. And D says only advocate fee are mandatory while court fee are charged as per regular civil court rule. What do you think about it? So friends, let's understand Lok Adalat in the simplest way. So if you talk about the Lok Adalat, they are the people courts. First point, Lok Adalat are the people court. Second point, the purpose is, quick and low cost settlement. That's the purpose. Quick and low cost settlement. Therefore, no court fee is charged. No court fee is charged. So it's called people court, quick and low cost settlement, no court fee is charged, right? Now, many cases come to Lok Adalat from regular court, like civil court, DRT. So these cases may have already paid court fee earlier, right? You know what happened? That from civil court, DRT, many court comes to Lok Adalat and they might have paid the fee earlier. So RBI Legal Service Authority rules say that if such a court referred case is settled in Lok Adalat, 100% court fee is refunded. 100 if it is settled there. Suppose if that particular case is settled in the Lok Adalat, 100% court fee is refunded. So Lok Adalat itself does not charge any processing fee, and banking pre-litigation cases up to 20 lakh are also free to file. So let's see the option that we have. Option A says a nominal court fee is charged but it is adjusted against the settlement amount. What do you think? See, nominal court fee is charged, no court fee is charged at all. That side is wrong. Option number B I think is correct, right? Because it says no court fee is charged is absolutely correct. What about C? It says that fixed Lok Adalat processing fee is charged. No. There is no charge. Lok Adalat charge zero processing fee, no special fee for banking matters. And option D says that only advocate fee are mandatory while court fee are charged as per regular civil code. No, that's wrong. So remember, Lok Adalat no fee, only settlement, right? So file for free, settle for free, even old court fee come back to me, right? This remind no new fee, old fee refunded. So what we learn from this discussion is that Lok Adalat do not charge court fee, and court referred case settled, then refund of the original court fee, no processing fee for banking or pre-litigation matter, advocate fee are optional. Therefore option B is the correct one, right? I hope this is crystal clear. So I think this question is repeated twice. Let me skip this question. Yes, let's try this particular question. This was exactly as it is asked in the examination, right? So the question is, as you can see, the following statement is regarding interest subvention for women SHG. Great question. So they have mentioned, loan up to 3 lakh in Kerala, district 7% effective interest rate with an additional 3% subvention. C says SHG loan between 3 to 5 lakh carry 6% effective interest rate subvention. D says SHG mentally must upon the limit. So which one do you think is right? So friends, DAY-NRLM, what is DAY-NRLM? Let me explain a little bit. So it gives this relief, it's called subvention. So it gives interest relief, we call it subvention. So this subvention or interest relief is given by the DAY-NRLM to whom? To the women SHG, right? So that they can borrow cheaply and do income generating activity. So there is something called category 1, right? There is something called category 1, or we call it category 1 intensive district. There are category 1 intensive district. What is this category 1 intensive district? Let me explain. So basically, in this particular case, SHG loan up to 3 lakh are given at 7% interest rate. And if the SHG pay on time, if they pay on time, what happened? They get extra 3% subvention. and that bring the effective interest rate down to 4%. So up to 3 lakh loan, right? They are given 7% interest, and if they make the payment on time, they get extra 3% subvention, right? So let's look at the option that we have. Option A say all SHG loan up to 5 lakh automatically get no. SHG loan up to 5 lakh automatically get, this is wrong. Actually 7% apply only up to 3 lakh only, and that too only in the category 1 districts. There are some category 1 district where it's applied. What about option number B? Yes, this is the perfect one. This is the perfect one. Option number C, it says that loan between 3 to 5 lakh carry a fixed 4%. This is wrong. Actually, loan between 3 to 5 lakh range do not get fixed 4% interest. Rather, bank are reimbursed to bring the rate down to 1 year MCLR. Bank are reimbursed to bring the rate down to 1 year MCLR or 10%, whichever is lower. What about option D? Option D is again wrong. It says subvention is available only when SHG maintain lean mark saving account with the lending bank. Absolutely false. Under DAY-NRLM, SHG saving account cannot be lean mark. Subvention has no link with lean or blocking of saving. So remember what we learned from this discussion. There is a simple rule. You can remember it. 3 lakh, 7% pay on time. 3 lakh, 7% pay on time minus 3%. Right, so you can remember it. There is a way you can remember it. 373 rule, right? 373 rule, right? So 3 lakh loan, 7% interest, 3% bonus for good repayment. So category 1 intensive district give 7% interest for SHG loan up to 3 lakh. Prompt payer get 3% subvention. Effectively, it is 4%. Loan from 3 to 5 lakh follow MCLR or 10% rule, not 4%, right? So if the loan size is more than 3 lakh, so it follow 1 year MCLR rule or 10%, right? I hope this is crystal clear now. Now friends, have a look at the next question. The next question, if you think that this video is adding value to your preparation, don't forget to hit the like button. Please hit the like button. Now friends, have a look at the next question. This question is based on co-acceptance of the bill. Question is, which of the following is a mandatory RBI safeguard before a bank co-accept a trade bill? Option A, co-acceptance may be issued for accommodation bill between sister or group concerned, provided both maintain good credit history. B, bank must ensure that bill represent a genuine trade transaction and verify the underlying goods in the borrower stock. C, bill drawn under bank on LC or buyer line of credit can be freely co-accepted to the facilitate trade. D, co-acceptance is allowed for any usance period up to 360 days without a stock verification if the borrower has an existing credit limit. Very good question. So let me explain a little bit about this co-acceptance. See, this is not just a question answer session. This is basically concept making session, concept building session. I explain each and every concept. So first of all, we should know what is the meaning of this term, so-called co-acceptance. You can think of it like this. Whenever a bank, suppose this is the bank, and this bank is co-accepting. Whenever a bank is co-accepting what? Co-accepting a trade bill. It is basically saying that, if the buyer does not pay, I will pay. If the buyer does not pay, I will pay. Bank is saying to the customer that if the buyer is not paying to the seller, basically, if the buyer did not pay, I will pay. That's called co-accept. Because this creates a direct liability on the bank. Yes, it creates a direct liability on bank. And RBI want bank to be extremely careful. Right. So before giving this guarantee, bank must make sure that, the bill is based on real sale. The bill is based on real sale or real purchase. So real word is super important. Second thing, bank must ensure that goods actually exist. Right. It is not fake invoice. Third thing is that goods are physically present in the borrower stock. Goods should be physically present. This is what bank has to ensure. And the fourth thing is that valuation that is done is genuine, not inflating the price. Fifth point is that transaction is not between related party. Transaction is not between the related party just to create, fake papers. So this condition must be exist. A real sale, goods must exist, physically goods should be present, valuation must be genuine, and there should not be related party, right? So now let's look at the option that we have. So option number A, if you look at it, says that, it must be issued for accommodation bill. See, accommodation bill between sister group and concern are allowed. So RBI strictly prohibits co-acceptance of house or accommodation bill. Why? Because they are often used for fraudulent discounting. So RBI prohibit this. This is not accepted. Option B, yes, this is the correct one. Right. Option C, bill drawn under bank on LC or buyer line of credit can freely be co-accepted to facilitate trade. Totally prohibited. Bank cannot co-accept bill where it is already the issuing bank. That would be double liability, right? So bank is already the issuing bank and it cannot, it cannot co-accept the bill where is already the issuing bank. Option D, co-acceptance is allowed for any usance period up to 360 days without stock verification. No, this is wrong. Actually, if the trade, typically trade usance is how much, 120 to 180 days. This is the typical trade usance. And stock verification is quite mandatory. This is mandatory step. Any borrower has a limit. So credit limit is not automatic permission for co-acceptance. So what we learned from this discussion is that, just one word if we want to summarize, you can say that, whenever I say co-acceptance, in the case of co-acceptance, we should check the good first. We should check the good first, right? No good, no co-acceptance. If the bank cannot see, if the bank cannot verify, if the bank cannot value the goods, co-acceptance must not be done, right? So what we learned from this question is that, co-acceptance is a serious bank commitment treated like a guarantee. RBI mandate verification of goods, stocks, valuation and genuine trade. No co-acceptance for, house, accommodation bill, group company routing, bill under letter of credit or buyer line of credit. And usually usance period normally 120 to 180 days, not 360 days, right? I hope this is crystal clear now, right now. Now friends, if you are looking for content for the last moment revision of CCP so that you can revise the entire content in very less time, check out our course on CCP in the description section below. Now friends, have a look at the next question. The next question says that which of the following type of advance will not be treated as NPA even if interest remain overdue beyond 90 days, provide adequate margin is available. Option A, advance against gold ornament. Option B, advance against NSC. Option C, advance against government security. Option D, advance against marketable share. See, try to understand what this question is all about. Let me explain a little bit. So you are familiar with, RBI IRAC, income recognition and asset classification norm, right? Please understand. Under the RBI IRAC, some loan are treated as fully secured. Some loan are treated like fully secured loan because the bank hold 100% safe, easily incashable security. Incashable security, that is the bank is holding. So even if interest is overdue for more than 90 days, this loan will never become NPA, right? So interest is overdue for more than 90 days. That means, overdue period is more than 90 days. This loan, they will not become NPA as long as the margin exists. As long as the margin exists, this loan will not become NPA. So these special fully secured include what, it includes term deposit, or we call it FDs. It includes NSC, National Savings Certificate, except for surrender. It includes IVPs, that is called Indra Vikas Patra. It includes KVP, Kisan Vikas Patra. It includes LIC. So let's look at the option that they have given you. Advance against gold ornament, right? So what do you think? Actually, loan against gold follow the normal 90-day NPA rule. If the interest overdue is more than 90 days, this is NPA. This is not the correct one. Advance against NSC, correct one. This is the correct one. Advance against government security. This is not included in the RBI exempted list. These loans become NPA after 90 days like normal advance. Advance against marketable share. Again, shares are volatile and they are not considered fully secured liquid asset. So first thing is that whatever asset we are talking about, it should be fully secured. But can you tell that shares are fully secured? No way, you cannot tell that, right? So the correct answer is NSC. Option number B is the correct answer, right? So remember, there is a way to remember this. Let me explain. So if they ask you FD, NSC, IVP, KVP, LIC, in this case, no NPA even after 90 days. So a small saving, these things are a small saving plus LIC plus FD, right? Safe, so no NPA. If collateral is government bank, small saving or FD insurance, a special exemptions apply. So in all these cases, you can see that either it is collateral is government bank or there are some special insurance case, small savings. So in this particular case, that rule is applied. Special exemptions apply. So what we learned that RBI exempts certain fully secured advance from becoming NPA even after 90 days overdue. This security must have fixed guaranteed surrender value. Example I have given you FD, term deposit, NSC in the Vikas Patra, Kisan Vikas Patra, life insurance policy, etc. Now friends, let's have a look at the next question. I think this is the repeated one. So the next question is, a bank guarantee is considered discharge under which of the following circumstance? This is a very good question. When a bank guarantee is considered discharge. So option A, they are saying when its validity period expire and no claim or invocation is received by the bank. When the beneficiary verbally inform the bank that no further action is required. Only when the bank unilaterally decide to close the guarantee before expiry. When the principal later completes partial repayment under the main credit facility. These are the four options that they have mentioned you. So let's have a look at the correct option. So basically, if we talk about the bank guarantee, let me explain. If we talk about the bank guarantee, it is like a promise from the bank, isn't it? It is like a promise from the bank that, if the customer fail, then in that case, bank will pay. If the customer fail, bank will pay. That is a promise, right? But this promise is not forever. Every guarantee has a validity period. Every guarantee has a validity period. Every guarantee has a claim period. Every guarantee has an expiry date. If the beneficiary, that means the person in whose favor the guarantee is issued, does not make a claim on before expiry, the guarantee is automatically finished. See, try to understand what I am telling you. If the beneficiary, right, that is the person in whose favor the guarantee is issued, if the beneficiary does not make a claim on or before the expiry, if the beneficiary does not make claim on or before the expiry, what happened? Guarantee is finished. Guarantee is finished. The bank has no more liability. The bank has no more liability, right? And the guarantee is said to be discharged. So this follows the Indian Contract Act rule about the discharge of surety and banking practice under RBI guidance. So what you have discussed that, that if the bank guarantee is like a promise from the bank that if the customer fail, I will pay. But this promise is not forever. Every guarantee has a validity period, claim period, expiry date. If the beneficiary does not make a claim on or before the expiry, then the guarantee is automatically finished. The bank has no more liability. Guarantee is said to be discharged. Now let's look at the option. Option A says when its validity period expire and no claim or invocation is received. Exactly correct. Option B, when the beneficiary verbally inform the bank that no further action is required. Actually, verbal statement have no legal value. A guarantee can end only by expiry or written release from the beneficiary. Option C, bank unilaterally closes the guarantee before expiry. The bank has no right to cancel a guarantee early on its own. Only the beneficiary can release the bank in writing. Option number D, when the principal later complete partial repayment. Actually, a bank guarantee cover performance or payment obligation. Partial repayment does not end the guarantee unless the beneficiary issue a formal release. So what we learned from this discussion is that, two conditions are there. First thing is expiry. Second thing is no claim. Right? These two things ensure that goodbye guarantee. Goodbye guarantee. Right? So no claim. Just remember, no claim, no liability. Right? This instantly tell you that expiry plus silence from the beneficiary means discharge. So what we learn from this discussion is that, bank guarantee end automatically on expiry if no claim is received. Beneficiary must claim before, on or off the expiry date. Bank cannot cancel a guarantee on its own. Verbal communication is useless. Only written release work. Partial loan repayment does not discharge a guarantee. So option A is perfectly correct. Now, the next question that we have is based on LLP, Limited Liability Partnership. Right? Which of the following statement is not correct? So the option A, they have given that, LLP certificate, ROC registration apply only to company. It apply only to company or only to LLP. Right? It does not apply to, sole proprietorship. So sole proprietorship is simply an individual doing business under his own name or chosen trade name. So there is no separate legal entity. So no ROC is involved in the sole proprietor. Now let's break down each and every option. So basically question is which is not correct. Let's have a look. Yes, not correct. So if you look at the option number A, so it says that LLP must register with ROC under the LLP Act. Yes, this is the correct one. LLP get legal status only after filing with the ROC, who then issue the certificate of incorporation, or we call COI. Yes, A is correct. What about B? Companies like private, public and OPC section 8 require ROC registration. Yes, every company must file MOA, AOA and get certificate of incorporation from the ROC before starting business. Option C, sole proprietorship must obtain ROC registration. See, this is wrong. Option C is wrong. A proprietorship does not get registered with the Ministry of Corporate Affairs. That is MCA. Right. There is no incorporation process, no MOA, no AOA. So business run using the owner's pen Only optional registration apply, like GST, Udyam, shop and establishment license. So what is the correct answer? What about option D? ROC issue the certificate of incorporation. Yes, correct. ROC check the MOA, AOA related filing. Right, DIR, KYC documents. Right, once everything is valid, ROC issues the ODI. So remember, ROC is only for companies as well as the LLP, not for proprietorship. Even MC does not register people, only entities. Please remember, Ministry of Corporate Affairs, it does not register people. What it registered? It registered only entities. So what we learned, ROC registration mandatory for LLP plus company, sole proprietorship, no ROC, run on honor pen, ROC verify MOA, AOA, etc. Now friends, let's do one numerical based question. Right. A company reports COGS. How much is the COGS reported by the company? 4,80,000. Now friends, question is as per the RBI 2017-2018 guideline, which of the following cannot be accepted as a collateral? Option A, gold jewelry like bangles, chain or ornament. B, gold coin up to 50 gram per borrower. C, primary gold in the form of bullion or gold bar. D, silver ornament within permitted weight limit. So basically, RBI has issued a clear guideline through circular. It is stated that, bank cannot accept primary gold. Right, please remember. It clearly says that bank cannot accept primary gold. What's the meaning? It means, like gold bullion. Bank cannot accept. Like, gold bars. Like, raw gold. Okay. Unworked metal. Why? Because primary gold is easy to misuse. Traceability is quite weak. And it is linked to money laundering risk. That's why RBI prohibits it as a collateral. So what bank can accept? Yes, bank can accept, gold jewelry and ornament. Right. So bangles, chain, necklace, ring, any ornamental or worked gold. Bank can accept gold coin. Coin can be accepted. Right. Jewelry can be accepted. And silver ornament and silver coin can be accepted. Right. So this can be accepted, this can be accepted, this can be accepted, this cannot be accepted. Right. So jewel yes, bars no. Just remember, jewel yes, bars no. If the gold is worked, like jewelry allow. If the gold is raw, if the gold is the form of raw, like bar. Or if the gold is form of bullion, then big no. And if the gold is the form of worked like jewelry, then they can do. Right? Please remember it. Now friends, have a look at the next one. The next question is based on MISS, or we call it Modified Interest Subvention Scheme. Which of the following statement about MISS is not correct? Very good question. Right. So options they have given: MISS provide interest subvention on short-term KCC crop loan up to 33 lakh with an additional 3% benefit for prompt repayment. KCC loan for animal husbandry and fisheries are eligible for interest subvention for only up to 2 lakh. MISS offers subvention benefit even on overdue loan as long as they are linked to KCC account. Prompt repayment within 12 months reduces the effective interest rate from 7% to 4% for eligible farmer. So these are the 4 options they have mentioned. So let me explain what is this MISS scheme is all about in the layman terms. So MISS scheme is the government scheme that reduce interest on KCC short-term agriculture loan. Right? On the short-term agriculture loan, it reduce interest. Now the core rule is very simple. This particular subvention is only available only when loan account is regular. If the loan account is regular and the loan account is standard, then only subvention will apply. And if the loan become overdue, what will happen? If the loan become overdue, the farmer loses the subvention benefit. No subvention. No subvention if the loan become overdue. Right? Now, the question is asking you, which of the following is not correct. Right? So let's look at the option number A. It says that MISS provide interest subvention on short-term KCC crop up to 3 lakh with additional 3% rate. Yes, bank get 1.5% subvention and farmer who repay on time get 3% extra benefit, bringing the rate effectively to 4%. And the government has raised the limit to 5 lakh in the recent budget. Please note it down. In the recent budget, government has raised the limit to 5%. Right? To 5 lakh. Okay. In the recent budget. But the question uses the 3 lakh rule, so option number A is correct. Now, what about B? KCC loan for animal husbandry and fishery eligible for interest subvention. Yes, this is also correct. These activity have a separate subvention ceiling of 2 lakh. C. MISS offers subvention benefit even on overdue loan. No. This is wrong. Actually, option C is wrong. Because subvention is available even for overdue KCC account. This is completely wrong, right? What about D? Prompt repayment within 12 months reduces the effective interest rate. Correct. If the farmer repay the KCC loan within 12 months, they get 3% prompt repayment. That is correct. So total C is totally wrong because subvention available even on overdue loan. No. MISS clearly states that subvention apply only to a standard regular non-overdue account. Once the loan become overdue, no 1.5% subvention, no 3% prompt repayment. See, basically what kind of benefit it is giving you? 1.5% subvention it is giving you. 3% prompt repayment benefit it is giving you. And interest revert to normal bank rate. Right. So MISS care only for regular account. Overdue means over. Pay on time, pay only 4%. Delay, pay full rate. So MISS apply to short-term KCC crop loan. First thing, please note it down. It apply to short-term KCC crop loan only. Crop loan limit for subvention is 3 lakh and it has been raised to 5 lakh. And if it is fisheries and animal husbandry, this is 2 lakh limit. Prompt repayment within 12 months, 3% extra benefit. Effective interest rate will get down to 4%. Overdue loan loses all the benefits. So friends, we have some more questions. If you want to get explanation for the questions, you can enroll in our CCP course. For more detail, you can WhatsApp me on this particular number or check out the description section for the course. Please like the video